Hey everyone, welcome back to the channel. My name is Pablo, and today we're looking into one of the most critical aspects of smart investing. Understanding key elements of financial health for stock analysis. Whether you're a seasoned investor or just starting, knowing how to assess a company's financial health is essential for making confident and informed investment decisions. Okay, let's do this. The income statement is like the heartbeat of a company. It shows whether the business is thriving or struggling. One of the first things to look for is year-over-year and quarter-over-quarter revenue growth. Steady growth means the company is on the right track, while stagnation or decline may raise red flags. Take Amazon as an example. During its early growth years, it consistently demonstrated impressive revenue increases, signaling its dominance in the e-commerce space. Next, look at the gross, operating, and net profit margins. These numbers tell you how efficiently a company turns revenue into profit. For instance, Apple's high profit margins reveal its strong pricing power and operational efficiency. And don't forget earnings per share, EPS. Historical and projected EPS trends show whether a company is increasing its profitability for shareholders. A growing EPS is often a sign of a healthy business. Think of a company's income statement as its report card. Would you invest in a business with straight A's or one barely passing? Every dollar you invest should work for you. Understanding a company's income statement ensures you're making smart, informed choices. Research the income statements of companies you're interested in. Look for steady revenue growth, healthy profit margins, and a rising EPS. Evaluating the balance sheet is your window into a company's financial stability. Start with the debt-to-equity ratio to assess how leveraged the company is. A lower ratio indicates that the company isn't overly reliant on debt to finance its operations, which is crucial during economic downturns. For example, Microsoft has maintained a low debt-to-equity ratio, reflecting its strong financial foundation. Next, examine the company's liquidity, focusing on its cash reserves. Companies with substantial cash on hand, like Alphabet, are better equipped to weather storms and seize growth opportunities. Finally, analyze the current and long-term assets versus liabilities. A company with more assets than liabilities is typically financially strong, while the reverse may signal trouble. Picture yourself owning a stake in a company that's built like a fortress, secure, steady, and prepared for any challenge. Strong foundations create lasting success. A financially stable company gives you peace of mind and confidence in your investment. Dive into balance sheets, focus on debt levels, cash reserves, and the balance between assets and liabilities. Reviewing the cash flow statement. Cash flow is the lifeblood of any business. Start by analyzing operating cash flow, which shows whether a company's core operations generate enough cash to sustain itself. Positive operating cash flow is a sign of a healthy, self-sufficient business. Next, look at free cash flow, or FCF. FCF reveals how much cash is left after the company covers its expenses and capital investments. Companies with consistent FCF, like Procter & Gamble, often use it to pay dividends, buy back shares, or reinvest in growth. Imagine owning a business where money flows in like a steady stream, enabling expansion, innovation, and shareholder rewards. Cash flow tells you how well a company can grow and adapt. The more you understand it, the more control you have over your financial future. Look up the cash flow statements of companies you're considering. Focus on operational and free cash flow trends. Comparative tools for stock evaluation. Now that you've analyzed the financial statements, it's time to compare the company to its peers. Start by looking at sector and industry performance benchmarks. How does your target company stack up against competitors? A company outperforming its peers is often a good sign of strength. Next, consider the company's economic moat, its competitive edge that protects it from competitors. Warren Buffett often emphasizes investing in companies with wide moats like Coca-Cola or Visa, which have strong brand loyalty and market dominance. Imagine investing in a company that stands tall while others falter. That's the power of finding a business with a clear advantage. Great investments aren't just about numbers. They're about companies that consistently win in their industries. Use stock screeners and industry reports to compare your target company against its competitors. Look for economic moats that set it apart. Closing thoughts. Analyzing a company's financial health is like peeling back the layers of its story. From revenue growth to cash flow, every metric tells you something about its stability, potential, and future. Remember, investing is about building your future one decision at a time. When you take the time to understand the companies you invest in, you're not just buying stocks, you're building confidence, wealth, and security. Which of these financial health elements will you analyze first? Let me know in the comments below. If you found this video helpful, like, subscribe, and share it with someone ready to take their investing journey to the next level. Thanks for watching, and I'll see you in the next video.